Well, good evening, friends. It's time for us to start our home investor meeting where we look at everything live. And tonight we are going to focus in on more ETFs. And we come on Tuesday nights and on Thursday nights at 9 p.m. Central Time to just kind of check in with each other and take a look at the stock market. Mainly, we like to focus in on dividend stocks, and we open up the comments for asking about ticker symbols that you're interested in. But tonight we've had a lot of questions about ETFs, which is the basis on where many new and existing dividend investors trust where to invest their money. And we're going to discuss why people choose ETFs and what are the ETF strategies they use for saving into their retirement, why people like them so much. I have up a comparison chart here comparing SCHD, VU, JEPQ, VYM, and VIG, which are all ETF funds. We're going to look at them individually. IYW is my favorite ETF, says Sonics. Hi, Sonics, how are you doing? We'll take a look at IYW in just a couple of beats here. And welcome, Wasabi Twinkie. Thank you for joining us this evening. And there's a message here on the end from my moderator that they are on to moderate. Okay, well, the reason why we're talking so much, hey, Wasabi Twinkie, how you doing? My son likes your name, Wasabi Twinkie. He wants to be called something Wasabi. We haven't let him have a social media profile yet. He's 12, but he's still a little bit very sensitive, so we'd like him to strengthen up a little bit because, you have to be a little tough to be on social media, and we just didn't want people to bully him, so... But he really likes your name. He's like, oh, Wasabi. He's like intrigued by it. Oh, Wasabi Twinkie. He heard me saying it from the hallway. And he's like, oh, what a name. Yeah, it's a great name. So I'm glad you picked that. Thank you. And we have in here, hiding on the sidelines in the other classroom Zoom, is Dave Carter out of Chase. And he was upset because we're looking at things on a 10-year for the ETFs. And he was upset that JEPQ was over here. But I'm like, Dave, JEPQ didn't start out 10 years ago. It started having more numbers in early 2022. So it can't catch up with the rest that we've got numbers on that we're going to be explaining on. But he was just getting all defensive about Chase making good products. But Chase doesn't need to defend itself, nor does it need Dave to defend them. Chase knows that they've been around for a while. They know that they got extra money from the savings and loan crisis, even though they didn't have as big of a crisis as other banks. I know all the greedy stuff they've done. So... it's just hard getting over the past because so many people lost money during the savings and loan crisis, and the government at that time was more concerned about bailing out the banks than its account holders. And the government really didn't need to bail out the banks because the banks already had, thank you for the hearts, the banks already had insurance backers, and they claimed, well, this money is for the banks to bail out everyone that holds an account. And that's not true because all the accounts are already FDIC insured. So where's all our fees and money going to if you needed extra money? That's like one thing that I just did not understand. Hey, Merck, how you doing? Where did you go live? I was looking for your channel. Well, I went live here. And the two kids in with me tonight, interning, Ross Winters and Darna Schlegel, were trying to simultaneously have me go live on YouTube, but it's not working that well for them yet. So we've had some issues with TikTok, not only with the delays and the glitches, but also every time we mention something else that their AI doesn't like, they shut down the live and they restrict it, because so many people complained. Even there's a person in here that works at TikTok corporate that complained that I didn't say anything wrong, but their AI is so sensitive, shutting down the live for every little single thing that it thinks that you said. So they're trying to test multi-streaming on different platforms, but a lot of our students, their parents and their kids, they find it the easiest to use TikTok even over the blue and white platform, or there's two of them. And so we're trying to do the best we can with parsing our words and everything, but still trying to help everyone out. That's why we have the resources set up on my profile for you as well to look at after. I got a strike for something misunderstood. See, Merck knows what I'm talking about. Merck knows. It's so hot out here. It was over 90 degrees over the past 3 days. It was over 100 degrees index in the house, and 2 of those days we were without power in our area, and it was just some hell. And you can't debate it or anything. No, you can't. Well, we were looking at ETFs tonight. We were looking at all of them because there's 4,000 of them, but there's no way we're going to get through 4,484 ETFs tonight, but we're going to get through some of the major ones. So my intern set up this comparison graph over the past 10 years, comparing out, because we were all debating about SCHD, VU, JEPQ, VYM, and VIG. VYM and VIG are Vanguard products. VU has its own holdings. SCHD has its own holdings, all which we'll go through tonight. But this is the past 10 years performance on them, which I'll go through them with them individually. But Dave, who works at Chase, is mad because he saw JEPQ all the way here at the bottom. But I'm reminding him that JEPQ has increased 55% since it opened in 2022, so he need not be so upset. But I'll go through the ranks with you. I'm trying for my hands not to get in the way here. So at the top here, we have, over the past 10 years, VU has increased 255% over 10 years. VIG has increased 214% over 10 years. SCHD, 195% over 10 years. That means price growth is what I'm looking at. VYM, 123% over 10 years. JEPQ has not been around for 10 years, so it's only on the 49%, but don't sell it short. It's just a little young, that's all. But we'll go through all of them and look. But we had a question up top here that I passed by, and I asked the person to wait a couple minutes. That was Sonic. Sonic says IYW is the favorite ETM. So let's look at IYW and see what's going on. So IYW is the iShares US Technology. And to get an idea of what's going on with it, the reason why people invest in ETFs is because they have holdings. It's a way of owning a lot of the companies that you want, but you can't afford. So when you buy an iShares US Technology share at $180.53, you can research under any public website by clicking holdings. You'll see that it holds shares in 145 different companies. So it's a boutique, it's what we call a boutique ETF, and we'll see a few of those tonight. And it has assets of $23.27 billion in holdings. That means that's the amount of shares it owns in different companies. So we see that iShares owns mostly their pie, which is 88% in technology. Then it diversifies a little bit in communication, industrials, consumer spending, and their little category of 2% they call other. So if you really want to break that down, you can go to their websites and look at each company they own. But the majority of what they hold top is NVIDIA. 17% of that, 88% is NVIDIA. Microsoft is 15%. Apple is 14%. Meta, Facebook, is 4.7%, and Broadcom is 4%. Of what they, so that's what makes up part of their 85% or 88% of their pie. So in terms of dividends, the dividend yield is paid every 3 months at 0.19%. But remember when I said to you guys, or I often say to you guys, the bank only pays 1.2%. This is paying far less than the bank at 0.19. Why? Because the price has gone up on it so quickly. They're only paying just a little bit of a dividend yield. And we'll take a look at that in a moment. But every 3 months from this, you're getting about 8 cents every 3 months off of this. So to take a look at the price increase, we look at the history of it. Now, let's take under consideration when iShares first opened as a fund. It was an IPO fund in 2000, and people were putting $31.50 a share to buy a share of it. It didn't really produce anything, and people just sat and waited, and it went down and down. I'm going to keep on dragging this for many years. So imagine having to wait 17 years for your investment to pay off. That's what people did that invested in this in the beginning, because it was just going slow. And there were little points where it hit $47, a bunch of people cashed out, and it hit $59, a bunch of people cashed out. Then it went all the way up to $113, and a bunch of people cashed out. And it went to the bottom over here at $82.71. Now, that was the sweet spot where people were starting to buy in, and it just took off from there. It just took off and took off and took off. So we'll look at the max range again before we go. I collapsed into the local range. But it took off January. It hit 156 January of this year. Then a bunch of people cashed out and wrote it down all the way to 144. So from 144, it's up now to where it is, 180. So in this year, if you invested in this fund in March at 144, your share is now worth $180. That's why people like this ETF, because of the fast growth. You know, they haven't made that much on many other ETFs. But now, with the tariff threats and the technology stuff going on, it lost $3.49 today. It lost 13 cents yesterday. But what are people going to do? They're probably going to start selling this at the 180, and it's going to get rode down, which you're welcome to do, Sonics. You're welcome to sell this and get your profit and let this ride down again. It'll probably ride down about $40, which would be your profit, so you could take or leave your profit, basically, if we're looking at the history of what this fund has done. And then ride it back up again. Maybe it'll earn another $50 after you ride it back up on the second try. So it's showing us that every 6 to 8 months, people cash out, then they ride it back up again, is what people are saying about this. And let me look at comments while we're going through. Which line is this JEPQ? That's an excellent question, Yeshi. We are going to look at it. It was the last line on the comparison total, but we will also look at JEPQ. Here, it was this last blue line, okay, because they didn't start taking investments until mid-2022 over here. But we're gonna deep dive on JEPQ, just looking at their updated facts. So here we are, and we're going to look up JEPQ for those that were asking, and then we're going to look at the comments to see what other symbols you're asking about. But JEPQ is currently $55.38. The way how JEPQ has always run is that the fund stays between $50 and $58. And people invest in this. This is a JP Morgan, and we'll look at the holdings in a moment. So they can earn the 11.19% yield, which is $6.20 for the year on $55. Okay, and it's broken into 12 payments, and they pay you every month, the first of the month. So it's about 44 cents is what they're paying on this every month. Anywhere between 44 to 49 cents, depending upon the price of it going up and down, basically, because I said it rotates between $50 and $58 over a 52-week period of time. So people that have invested in this for years that are getting ready to retire, what do? They plan their retirement 6 months in advance, graduating out of these funds and cashing out. Why? Because they want JEPQ to come as close to $57 or $58 to cash out, to make the most out of cashing out. They don't want to cash out of it when it's between $50 and $52. They want to wait for it to go higher. So they look back at the price history, and they try to choose the point in time where it may reach that, which is, most often when we look at the price history on JEPQ, it's between Q3 and Q4 where it reaches the higher prices. So you're not going to want to cash out of this right when you retire. You're going to want to plan a little in advance so you can make the most out of this and leave off with it, is the best advice that other dividend investors have given to other people retiring after them, basically. But there are people that have just held their money in this. This has only been around since 2022, so there's a lot of new investors in this, and that's why it was developed based upon the NASDAQ holdings. And let's see what these companies are. So this fund is holding 108 companies, and they also hold NVIDIA, 8.75%, Microsoft, 7.44%, Apple, 6.58%, Amazon, 4.91%, and Broadcom at 4.32% as their technology stock. They also have some consumer discretionary communication services, healthcare, the consumer staples, industrials, utilities, materials, and financials. And this is what a diversified portfolio looks like, but it's very tech heavy on one side, as you can see. So when you're investing in JEPQ, you're investing actually in 108 companies at $55 a share. Scrolling up through comments. So is a fruit basket of stocks that private interest controls? Pretty much, Merck. They choose their sectors. There's some ETFs that are based off of certain themes, like all utilities. Some are tech heavy, but they choose certain stocks. In our Patreon growth group, the deeper members are investigating and researching an ETF that only does premium. They have like a Wall Street team on their holdings division where they just research the best, the highest, the best in financials, and they cherry pick those companies only to be in their ETF. So there's a lot there. Like I said, there's over 4,484 different ETFs to look at. We can't look at them in one night, but we could definitely look at the top ones. ASMLs. Hey, Zonky Donkey, how you doing? Zonky Donkey is asking about ASML. Let's see what you want to know. So ASML Holding is out of Nevada, and it's $743.61 per share. ASMN has only been paying a dividend for 1 year, so it's brand new. Okay, the dividend yield is 0.82%. Why? Because they've had a fast growth in price in that 1 year period of time. Now, keep in mind what I've said. Companies that are 10 years and younger, they don't have that payment history, and they can easily stop paying dividends at any time. But we've also seen dividend kings do that too. But I still have to give out that warning anyway. So let's look at the price history and see what's up. with this. Why are they saying their dividend growth is 8%? Well, keep in mind that they were a penny stock since 1995. And the reason why I show you this, I had one person write me a letter say, well, it's easy to go back in the past and say, look at it now. That's not what I'm doing. I'm saying, look at this a long time ago and look at how long someone would have to wait with their investment before a company like this pays off. It's for your education to know that not all these companies take off overnight. That's why I go back and do this. So in 1999, okay, this was $2.88. Now, this was a penny stock at the time, and they were just a common stock. They had no plans on paying any kind of dividends. They only made the decision to pay dividends a year ago. Okay, so nobody back then knew this. It was not in their financial plan back then. So all the way to 2019, they waited. And then this became $211 per share. Bunch of people cashed out, took it down to 186. Then it rode up a little bit to 309. Then a bunch of people took it down to 295. Then they started riding this up to $706. 2021, this hit $706. Bunch of people cashed out, wrote it down to 494, wrote it back up to 629, wrote it back down in 2023 to 716. Then it went all the way back up to $970 in March of last year. Bunch of people, you bet, cashed out. Okay, then it went all the way up in August. It was from 925, it went up to 1,052 June of last year. Bunch of people cashed out. I had missed a beat there. So we have, from that point, it has never come back to that $1,000 per share. It's gone down and kept down to $743.61. Okay, it went below that to $666.72, which that's 666. We know what we think about that number. Then it went up from there to where it is now. July 21st, it was $719. Now it's $743.61. That's the long roller coaster story of ASML. So we see where they started out with nothing and accumulated into something. But here's the thing. They're only paying that 0.82% dividend. Why? They're still trying to grab off of last year's $1,000 momentum. They should have raised that dividend yield a little bit, because this has lost like 300 and something odd dollars of money from where the price was at its highest. So I don't know what to say about this, if people are going to continue cashing out and losing money, because really I need to look at this from the standpoint of this company has not come back up to $1,000 per share yet. The forecast, what do the forecasters have to say about it? Only 5 analysts are looking at it. And those 5 analysts all believe that it's going to come up in the next 52 weeks to $914 per share. If it surpasses that, they say it'll go up to $1,100 in 52 weeks. Well, we shall see. We shall see if it does. But even if it does, this stock has a history of a bunch of people cashing out when that happens. Okay, and when it does, it may ride down right to where it is right now. So I personally, in my own opinion, would just wait, because the dividend here is still, the dividend yield 0.82 for the 1 year. I'm not buying it because it's not past $1,000 per share yet. It is my own little opinion on it. But you could look at the price history and research and see what you come up with. That's what I'm saying. It's my little opinion. Thank you, Sonic, for the thank you. GPIQ Jeremy Regal is asking about. Okay, Jeremy, let's take a look at your ask. which is Goldman Sachs ETF, $50.44 per share. It lost 53 cents today. It was up by a penny yesterday, but it lost it and went down 53 cents. They're doing the dividend every month on this. They're breaking down $5.02 for the year, and they're paying, which is 9.99%, 9.95%. So they're breaking that down and paying it every month. So that's about 44 cents a month they're putting on this. They're saying that this has had no dividend growth. So it's truly a 9.95%, nothing more than that. So if we take a look at the history, I'm sure we're going to see the price is going to remain see, this is the history of it. The price, it always trades sideways. So no matter where you go on this, even if people come sell out, it always comes back to right around the same price, maybe with $1 or $2 fluctuation in one way on the positive or on the negative. But people invest in this NASDAQ 100 purely because the bank's paying them 1.2. So why not invest in this and not worry? Make your 9.95% off of 50.44. And what they make their money off of is the 106 holdings that they have. They have $1.34 billion in assets. So this ETF is predominantly made up of NVIDIA as well, Microsoft, Apple, Amazon, and Broadcom. So they have other sector allocations in their holdings that you could look up, but that's pretty much the bulk of their holdings. So it's for people that just want to focus in on, the price is not going up. So you don't have to worry about when you sell this. Price is always going to be around the same, and you're just in it to collect your 9.95% on it. I've been buying FIW, a water trust. Okay, Mr. Tommy1123, I've pinned your comment, and we will take a look at FIW. First Trust Water ETF. Thank you for the hearts. So they're paying 0.68%. They're up 87 cents today. Water, if its holdings is a bunch of water utility companies, 38 of them, natural resources. They hold $1.93 billion in equity. So water is definitely something we all need to live and breathe. So it's called the industrial sector, if you want to know, and most of their investments are in that, where their top holdings are IDEXX Labs at 5.5% of that pie of the industrials. That's 58%. Ferguson Enterprises, Xylem, which is spelled XYLEM for those of you taking notes, Veralto, and American Water Works Company at 3.91%. So if you're interested in the water utility sector, like some people like gas, some people like electricity, some people like the mobile communications and telecom and internet, well, this is for those of you that want to invest in water. There is First Trust Water ETF FIW. It's $113.60 per share. Let's see what it's paying on dividends with this. On the dividend, it's 0.68%. Why? Because every 2 years you hold this, your dividend growth is 22%. So you count holding this for 2 years. When you sell it back, not only do you get that little dividend that's paid to you every 3 months, which again is around 23 cents a month, on 23 cents every 3 months, I'm sorry. When you decide that, okay, I'm tired of this, I'm going to sell it, when you sell it, it should be 22% for every 2 years you've held this. And that's the story on the water, folks. I'm going through comments. I'm sorry. My finger's a little slow here. I liquidated my NVIDIA at 182. Feels good. Now poke 3, RIP says that he liquidated his NVIDIA, and it feels good. And that may be because of the upcoming tariff scare, again, coming up with this company. However, the holdings, the ETFs that hold NVIDIA are not liquidating. They have enough assets back behind it to hold on for the ride. So you might want to look at an ETF that is tech heavy if you like NVIDIA type stock. Zoinky Doinky says you might regret that, low key. And I'll get back in with the connection, Poke 3 says. M says your contact is so helpful. Do you ever read the earnings transcripts? I do in my deeper level groups, but because more of the people that are online, most of them are beginners or students or parents of beginners. And that's going to, they're still trying to get a hold of the basics. So the earnings and the deep dive, we consider that more of the deep dive, which is in a separate group that we have for people that are into deep diving into more of the details. Moose's Ghost asks, what is my take on NVIDIA? Well, let's all look at the facts on NVIDIA, and we could all make our own take. How about that? So NVIDIA's symbol is NVDA, $175.64, down $6.37. And it's interesting because there's a lot of the social media traders like trading this and Tesla and Google Alphabet, and they like riding this up and down all day and laughing on social media about it, but they got their tuchus handed to them today on it. Now, NVIDIA was just a common stock. It only started paying dividends 1 year ago. So they were such hot shots. They were looking at their previous growth before all the political problems going on. Thank you for the hearts. They're saying that, we're only going to pay a dividend yield of 0.02% because our stock is going to grow. They didn't plan on all this stuff happening. So their forecasters say, there are 43 analysts looking at this saying, well, even though it's 175.64, we believe things are going to pass over in 12 months, which is 52 weeks. Sorry, I was misspeaking. And we believe that this price is going to get past $189 per share and right up to $210 per share. That's what 43 analysts say. But I think a bunch of people are cashing out right now. They're so scared. I'm thinking the opposite. I'm thinking this may drop to $100 and then it'll ride up to $210. So that's my opinion from looking at what's going on with this. But you're welcome to hold on to it. The forecasters recommend you hold on to it. Or if you want to disconnect and wait for it to drop and pick it back up at a lower price, then more power to you either way. My opinion differs from the analysts. The analysts believe this is still going to be going up, even though it's got a minor setback right now. I think it's going to go further down before it goes up. Either way, we both agree it's going back up. We just have a disagreement as to when, basically. So I gave you my take. I gave you their take. I gave my view on NVIDIA. Now I'm asked about SoFi, which is SoFi Technologies, $22.75 per share. The 15 analysts looking at it say, hold on, don't buy anymore, because we only thought it was going to be $17 at the most this year, and it's gone up to $22. There's only one analyst that believes that it's going to go to $26 and stay there between $17 and $26 for the rest of the year. So the analysts reporting in for the forecast, they all agree, whoa, hold it, don't buy anymore, don't sell it. If you don't own it, don't buy it, because we're not sure when it's going to drop. Okay, if we look at the price history on this, see the bumpy ride it's had all along, but we'll go here to the end. It's got 3 bumps. So here, July, it was $21. bunch of people sold out, went down to 21.39. So it went down by a few cents, and they wrote it back up to 21.81. Then a bunch of people sold when it was at 21.81. Then it went down to 21.02. Then it's gotten rode up again to 22.75. So every few cents up and down now, it's become more trigger sensitive where people are riding it up and down. That's what's probably making it difficult for the analysts. But this stock has withheld the test of time since 2021 when it started offering its opportunities. Every time it's gone up, people have cashed out, wrote it down, bought it at the lower price, wrote it back up, down. We could see the roller coasters happening. The scarier wait was November of 2021, where it was at 22.97. That was the longest ride down. And it took all the way until 2024, December, for this stock to come back up again. So that was a scary 3-year wait for a lot of people. And SoFi, during that time, they started getting into higher risk lending to kind of get through the times. So they were sending a lot of people that weren't worthy of credit opportunities to have credit during this time. They were getting into riskier, higher interest lending just to get through. And then they started making money back. And this is where they're at now, the 22.75. So do I think a bunch of people are going to ride this down? Yeah, I think a bunch of people may ride this down, in my opinion, based upon the history, back to around $20, $17, then ride it back up again, hopefully into Q4 when the economy gets better. So this is our wait, watch, and see on the SoFi as well. Thank you, Jeremy. Hey, Dwayne, how you doing? Good to see you, Dwayne. Always good to see you. Okay, let me see. We have some questions in here that I don't want to skip. Triple leverage NVDA. Okay, Ollie. Thank you for your opinion. I'm up 50% with NVDA. And then, by the way, I had a trader message me about these ETFs that he buys 100 shares and he trades their options. And he said you can make a lot more money doing that way. But, with a lot of these that we're looking at, with SoFi being down $1.48, and we have other ETFs that are down, right? It really depends upon what you're doing, because anytime you add trading into a factor, the reason why I don't trade is because I have 8 dependents and 3 adults that I take care of. That's a lot of people. So if I lose a penny, I'm really sunk in a hole. There's nobody coming to bail me out. There's no government coming to bail me out of my debt. So I don't trade because I don't want to lose a cent for the people I take care of. If you can assume the risk and you could ride through the losses and you could buffer those losses for yourself, good for you. I'm glad, but I don't take the risk because I don't want to lose anything. So I dividend invest so I don't lose a cent. That's my strategy, because it's a different life that I have with all those people depending upon me than you may have. You may be single and not have any dependents, and you could do a whole bunch of things, that are high risk or high yield. That's great, but I don't. RP asked about PLTR. Thank you for the hearts. And also, in good conscience, I can't tell you to do things where you're going to lose money because it's not my money. You have to make those decisions on risk. I can't. And then we have, people that are asking to come in on the live, but typically I pre-vet, or one of my interns pre-vets. They want to know why you want to come on, and I don't know if you're ethical. We haven't vetted you. So, we can do that if you make those arrangements in advance. If you can really help some people out there, then we want to know who you are. Palantir Technologies is PLTR, ticker symbol 157.75. Another trading disappointment for today. The market closed when it was down at $16.28. The day before, it was down $4.24. So in 2 days, it lost $20, the stock. But we take a look at the history of it for the reasons why I said before, so you could see how long people waited to get paid by Palantir. So when people, I'm trying to find my arrow if I can. When people first started investing in Palantir, it was 2020, and it was $10. It was an IPO, okay? Then they had to wait all the way until October 30th of 2024, all those years later, for it to start to pay off at $43.69. So they waited until January 2025 when it got down to $65.91. Then a bunch of people cashed out. Then they wrote it up again to February the 7th of 2025. A bunch of people cashed out when it got up to $110, February of this year. Then they wrote it all the way up to where it is now, $157.75. Little bits of cashing out along the way, but it was pretty much, a steep climb up from where it was earlier this year in March, February period of time. So that's the story of Palantir. Does Palantir pay dividends? No, it's a common stock. Okay, it offers no growth, but we look at the price history for the growth, which we just did. They're saying currently, if you own Palantir, you have had a 13% loss currently, is pretty much what they're saying about it. What does the forecast say about this stock? Well, the forecasters are saying if you don't own it, don't buy it, and if you own it, hold it. They are saying that it has surpassed, they only thought it was going to be $134 per share this year, and it's gone up to $157. So they're waiting for a bunch of people to cash out. There are 8 analysts out of the 16 analysts that have looked at this that it said, well, people are going to cash out anytime now, or they'll wait till it's $200, then they'll cash out. Then it's going to probably drop down to 110 again, based upon the price history, is pretty much what the consensus of the of what they're saying about this. So you could read the different price histories and the different analytical takes on it. They're all slightly different as to when or at what point it's going to drop. They all agree it's going to drop. They don't know at what point, but they're saying not to buy it right now and to hold it if you own it. It is all that they're advising at this pretty much at this point in time. So Oliver Rabbit says, good point. I have a 7-figure income and a large account. Good for you, Oliver. We like hearing people win. John Hassenkoff asks about CSX. I have a friend that works at CSX who's in Alabama. Very wonderful lady. CSX is a lot of good people. See, if it's what I'm thinking about, CSX, they got her traveling all over the place, but she really likes that job. So CSX is currently at $36.52 per share, and it's up 53 cents at the end of the trading day. Yesterday it was up by 8 cents during the trading day. There are 23 analysts, looking at this, saying that it's a good time to buy it because they believe that it's going to be going closer to $45 per share over the next 52 weeks. So that's what they're thinking on this. So we look at the dividends on this. So CSX has been paying dividends for 20 years at 1.42%. They're saying that for every year someone has held this stock, okay, that they have grown by 4.6%. So we take the 4.6% per year of growth in price and we add it to the 1.42%, and we get a little over 6%. I'm sorry, I'm not doing the math well in my head, in dividend yield, but we add those two things together. They're also continuing to say that the dividend itself, the dividend now is 1.42%, but the payment, because of the price per share going up, the dividend has grown over the years, every 2 years, by 8% as well, is what they're indicating. So the dividend's like 13 cents that they pay every 3 months. But for a railroad corporation, this is, a nice fixed income. And a lot of the people that own stock in this company are people that work or live nearby it, or know people that work for it. And they hold on to this not only for the steady payments over the past 20 years, but also because they're going to make a little bit on the price. It's a very affordable. What is this, $36 per share? So it's very affordable per share. For under $50, you're entering into a stock with a company that has a lot of government contracts. They have to work. They're part of the transportation infrastructure that gets your goods and resources from point A to point B, basically. So they are a much needed company. They're a needed resource that's going to work in any economy. And that's why people like CSX, pretty much. So, should you also look at an expense ratio on an ETF? Granny 0804, that's an excellent question. Some analysts do, and they like expense ratios that are close to 0.06%, like SCHD is an ETF, which is closer to that. And some look at more of the growth in price and the dividend yield than they do the expense ratio. So every dividend investor has their different strategy on that, Granny. Are you trimming PLTR after today? Regents, is that a question for me, or is that a question for the person that asked about the stock? I'm not trimming it, but I don't know if the person who asked about the stock could answer Regents 56 question in the comments. PLTR going to 100, LOL. No, well, that's what they say based upon the price history, no escape. I auto buy a share of Coca-Cola every week at the previous rate when it was 58. Love dividends. Good for you, Shaggy. Yeah, some people, are just so familiar with companies. They set up to auto buy a certain amount every week or every month and automatically have that investment. Some people set their dividends to drip, which is to constantly reinvest the premium so they can buy more shares in a company. So either way works. Do you like NLY? It's not if I like or I don't like. It's more or less, how is the company, what's it doing for me? So Annaly is showing up, the ticker symbol NLY is showing up at $20.74 per share. So they're paying the dividend yield at 13.5% every 3 months. So that's $2.80 on $20.74. What does the forecast say? Let's ask, do the forecasters like it? Well, it's coming close to the point where they're going to tell you to stop buying it, because it's almost at the it's past the $20.69 that they predicted it would be in 52 weeks. So they're concerned about that price dropping down to 19 cents. It's past it by a few cents. So it's not liking or not liking. It's for the analysts. They're just a little bit nervous that Annaly has passed it by a few cents. Only 2 of the analysts believe it's going to go up to $23. The rest of them believe that we're nervous, don't buy it, don't sell it, because this may drop down in $1. But if it drops, it's not a whole lot, basically. Dividends on this, again, 13.50, but we look at the history, it's a higher yield. And the reason why is because the price per share has significantly gone down. At its best, it was $61 per share in 2008. It has never come back to that since 2008. And that at its best recently was 37.56 in June of 2021. It's 2025, has never come back to it. So if I'm just looking at this on the price history alone, Annaly is losing money. So we can read into their financials or their company news or their financials and see why. But by all practical purposes, it's taken them a long time to bounce back, not months and not even years. They haven't bounced back yet, is what we're looking at in the price history. So that's why they're paying the higher dividend yield. But when you sell that share back, it's going to be lower than $20.74. So it's like a delay in losing money, unless you've got 5 to 7 years to park your money in this company to see where it ends up. Okay, but so far it has not come back in 3-4 years, is what there pretty much is. Now, JS, you're asking about NVIDIA, but we've already gone through NVIDIA, so I'm hoping that you saw it earlier, and this is just my delay in looking at your comment. If not, we'll quickly recap it. Oliver Rabbit says, margin is very important. I earn a 7-figure income, so I can afford risk. You can't just rely on analysts. Well, in the beginning, and from teaching in an educational standpoint to students that are just starting out, Oliver, you want to tell your other students that there are analysts out there and they have all kinds of opinions. And the reason why you want to look at analysts, because you want to first form your own opinion. And you want to look at what the analysts have to say. Then you want to look at what really happens. Then you're able to go back and see what points they analyzed, if it was a good analysis, and how they saw that coming. And that's how you learn to increase your own batting average. So that's why we look at analysts, so we can learn how to discern and make similar distinctions based on patterns that we may not have caught before without reading their analysis. So, so we look at everything, basically. We look at the company as a person, as an individual, and we judge it by its individual merits. For example, if a certain person is in charge of a company and they have a certain way of running things and they have a certain way of doing things, we familiarize ourselves with that and with their track history and everything else, and we're able to even make distinctions on the stock with that as well. So, what do you think about Cisco? Okay, Annie. Well, Cisco is in many ETFs that I had mentioned on my video because it is a holding in a lot of them. But Cisco is a company by itself. Like if you can't afford a whole share of Cisco, it's only $66. But there are companies that buy into Cisco on hundreds of thousands of millions of shares to really make money, and they share the dividends on that. It may be more than what you could afford to put in your own portfolio, which is why they choose a dividend. But we go back to 2000, where it was $54.75 a share. Then a bunch of people sold out, and it's just starting to come back up. It's been through a lot of ups and downs every couple years. But the company, if we look over here, every couple years, it's been through its ups and downs, but it's always bounced back. So right now it's at $66.76, climbing back from being at $61.34. And then last year, this was $45. So it's really climbed up, it's really climbing and trying to make its way. So the dividends on Cisco is 2.46%. They have reliably paid dividends over 14 years. They have never missed a payment, basically. They're saying that every year that people have held their stock, the dividend growth has been 2.52% on it. So currently the dividend is 2.46%. So what they're doing is they're paying $1.64 on this. There's two strategies that people use for investing in Cisco. Either they buy a whole lot of shares themselves because they really try to take advantage of it being just $66 per share. But there's some dividend investors that only prefer to invest in Cisco through an ETF that holds it because it's got the other bigger holdings to short up in the event of any losses. So on this particular stock. So the dividend will still be up because it's got other successful companies around it, is what they're saying, versus taking the hit every time the stock goes down. So that's just the personal opinion of different investors. Thoughts on ULTY? That must be a yield max. Now, most of the yield maxes aren't doing so hot during this period of time. But the ULTY is the Yield Max Ultra Income Strategy. So it's 573. We looked at this when it was 590. We looked at this when it was $6.60. Here's the thing with it. Every time it pays out a dividend, look at this mountain slope going down. Okay, these are running out of money. Okay, it's not paying the $124.68 on its highest. It's paying it on a decreasing price. So it's $7.14. And if you're invested in this, you may want to speak to your accountant or your tax strategist, someone that you trust with your money on this, because many of the people that have cashed out on this and have had to pay their quarterly taxes because they're self-employed have had to pay taxes on their dividends on this, depending upon your tax situation. So you may want to speak with the tax strategist when you're getting ready to cash out of this to figure out what to do. But they pay a dividend once a week. They break it down on this. Trying to find my little arrow thingy, and I'm not able to. So I'm not looking so professional right now. Sometimes I lose it. So they're paying about 10 cents a week on this is what they're doing currently. So it goes to say with what my thoughts were before, if you have no dependents and you could take on a higher risk, then that's great. You know how much money you can lose. But for somebody that doesn't want to lose any money, they're going to be choosing holdings that are 13% or less. There's a risk in all investments, but the higher over 13% your dividend yield is, the higher the risk, the higher the ability to lose money is pretty much what we're saying. Dividend yield chasing is a terrible strategy. Just buy broad index funds and go for total returns. Well, thank you for sharing your strategy, Batman. We appreciate it. Yeah, dividend yield chasing, there's a lot of different opinions that investors have over dividend yield chasing. If they're younger investors, and they're not retiring anytime soon and they have the money to lose, they're going to chase that to try to make their money. But they also have to know that they can lose that money too, because the risk is higher. For people that are 30 and up, 30 to 50 or so, yeah, there's still some dividend yield chasers in there. But people that are really socking it away for their retirement to have something to live off of don't really take a risk over 13%, because they want to have that. They don't want to lose any money, and they want to have all the money they can to retire off of. So that's pretty much what the strategy is on their neck of the woods. Edward Skeletrix, THTA. Let's see. THTA is the SoFi Enhanced ETF. So they're paying a monthly dividend of 13.55%. So they're saying for $15, they're going to pay you $2.04. The thing is on this one that, yeah, they're going to pay you monthly, but there is no dividend growth on it. Let's look at the price history to see if it's declining. So we take a look at this from the beginnings. It was $20 per share. They're not paying the dividend yield on that. Then it had dropped and traded sideways for a while in 2024 to $18 per share. Then around April, this dropped all the way down to where it is right now. It was at $17 and it went to $15. So every 2 to 3 years, this is dropping in price. So what this tells us is that if you're buying in based on the price history, which is $13.55, that depending upon when the last drop was, which was about a year ago actually, if we're adding up the time, you're not going to be able to be in this for more than a year. Then it's going to drop again in price. And even though you've made the dividend yield will be a little bit higher, but the price will be lower. So you're going to have a loss when you sell it. So with this one, you have to watch when you're going to sell it. It doesn't drop as quickly as the yield max funds do, but it does drop every 2 to 3 years. And it's just coming up this year to make another drop on that one. Thank you. I take the dividend from my NOY and buy Coke. Well, good for you, Everyday Inspiration. There's a Coke in every part of the world, I've found. Edward says he's been looking at that one. Yeah, look at it and study it and discover with that one a safe exit and entry point to get in and out, because you know you're going to have to get out before that price drops, Edward. And if you choose, would you go with QQQ or GPIQ? That's a good question, Zoiky Doiky. Let's pin this comment, and we'll look at QQQI. Well, I'll look at it together and see what's happening. So QQQI is 53.18, 13.82% on the dividend yield paid every month. So they're paying $7.35 on the 53.18. With QQQI, it's always going to be around the $53. There's no growth. This is kind of like the JEPQ that started in 2022. So it's always going to be at this price. You're not going to make money on a higher price. This fund rotates between 55 and $50, basically, back and forth, trading sideways. So every month when it makes a payment around the 23rd of the month, so they just made a payment July 23rd, they're getting ready to pay another one, there is no dividend growth. So with this one, it doesn't matter when you sell it back, there is no dividend growth, but you don't want to have a loss. So you definitely want to wait till it's a few cents higher than the price that you bought it when you're getting ready to sell it back. Okay? So then we take a look at GF. What was the other one you said? I'm sorry. I'm so sorry. It's going to make me drag a puzzle. Just a moment. We have a delay in our list. Okay. I didn't drag it exactly, but it let me pass. GPIQ. I found it. So we look at the Goldman Sachs. Now, we have the same thing. It's pretty much the same, except Goldman Sachs is a little bit lesser in price than QQQI. With the Goldman Sachs, you're earning the 9.95% per month that we had discussed earlier. I believe someone in the live asked this question earlier about Goldman Sachs. So it's 44 cents a month that you're getting paid on $50.44. But there's no dividend growth, and there's maybe a little bit of price growth, anywhere between $49 and $52. So you have to also watch when you sell this one that you sell it a few cents higher as well. But on the other one, the dividend yield is higher at 13% versus this one, but this one is lower in price per share than the other one. So those are the two differences. But the premise of both funds is the same. No dividend growth, investing straight for the dividend yield. And both pay the monthly dividends. So I hope that helps answer your questions, Oinky Doinky. So Edward Skeletrix, I thought I answered THTA already. NLY pays a great Debbie. Yeah, if it's not losing money, which it pays the dividend, but it's losing money. So when you sell it back, you're going to be taking the loss that way on NLY currently, because it has not come back in price. BRK.B, that's the buy. Yes, that's the buy user. Let's look at now Berkshire. To tell the story about BRAKB, we have to talk about BRAKA. So let's talk about the A really quick. So Berkshire Hathaway developed BRAK as a way of investing in quality funds and giving a premium portfolio to people that were really looking for it. Thank you, Anna. Okay. BRKA, I'm sorry. Berkshire Hathaway A. So we look at the history on this to tell a story, which is when the fund started in 1980. Okay, wherever we all were. I was watching Channel 7 and Channel 5, watching the A-Team and different strokes and facts of life and stuff like that. So it was $275. Look at how much it is now. $727,200. Well, it's too late for anyone to invest in it because who has $727,000 per share to invest in it? So the Berkshire people came up with BRAKB, hoping to do the same thing. So I had to tell the story about A so they understand why we like B. So B is at $485 per share, and the dream is in 20 years of holding on to this, not selling it, holding on to it, that it will become something like Berkshire A. That's the dream that investors have. So we look at it when it first became open, it was $20 per share. In 2020, it was $227 per share, still very affordable. And since then, it's grown to $485 per share. So it's grown a couple $100 in about 4 years. So we expect every 4 years for it to keep growing at this rate. And that's why people are excited about buying it. So it was up $6.79 yesterday. And those holders of that fund, including myself, are quite happy. We want that to happen. I like Micron long. That means that you want to hold it for a while. So Micron Technology MU is at 122.05. Okay, so it lost $1.50 yesterday, but you're not going to panic sell over that. So we kind of glance around and see that it's had a history of being high and low. Let's get up to some recent data. May of last year, this was $125 per share. It's gone down and up, down and up, down and up. Now it's at 122. Okay, that's the story on Micron. In terms of dividends, they're paying a 0.38%. They're hoping that it'll have dividend growth, but right now it doesn't. Right now, the yield on this with the price is still negative 2%. So they're saying that they're paying the dividend yield of 30.38%, but really we add the negative 2.37% and investors are down on it currently. So what do the forecasters have to say on this? They're saying, don't worry, it's going back up in 52 weeks. We expect it to go to 152, and then from 152, we expect this to go to 250 per share. That's what 28 analysts are saying. So we've got 3 of the 28 analysts that are saying, well, hey, this might still drop further down to $84 before it does anything. But most investors in this stock are not selling. They're not panic selling because it has had a history already 3 or 4 times of going up and down. So they're just going to hold on to it like Out of Sight Gear says, I like Micron long. He's one of those people. Thank you for the love. Hello, Monu on Ethereum was on Mario. Awful day. I expected to have it staking in the next few months. Well, Steve, I'm not a crypto gal and I don't stake, so I wish you the best of luck. I don't know about anything. David says reverse split. On Micron? Okay. We'll wait for it, David, if that's the case. Alrighty. And let's go through to see what else is happening here. Mozart asks about MMC. MMC is Marsh & McLennan Companies, $210.93. Currently, it was up $3.28. So they're saying on this that it has it's getting close to the point of being at the 52-week point of it predicting to go up to $235 per share. Then it's going to then they're advising at this point in time, if you own it, hold it, and if you don't own it, don't buy it, because it's so close to its price point, they don't know if people are going to start cashing out on that. But the dividends, let's see if this pays any dividends on it. They've been paying dividends, they said, for 15 years at 1.73%. They've predicted that every year that you own the stock, you add 2% to it, is what they're saying on this stock. So if we take a look at the history, just like any other company, it was really down, took a bunch of years to pay off. Then when we're right about here, December of 2019, it started to take off as a company at $111 per share, and it's done its little ups and downs. Now it's at $210.93 is pretty much what we're seeing in the price history of it. So they're saying that from this point, which is 2020, all the way to current, you're adding another 2% gain per year to price on MMC. Doesn't die, Mozart. I don't know if you're referring to MMC. It doesn't die. It looks like it's still going up. Rowland asks, can you show me the math on how much dividends would a stock give? Well, the math is public, and that's what we're going through right now. Currently, in my videos, I do have the math on dividends, or on the YouTube channel that I have, I did a calculation on Coke dividends that you could look at. Gary Miglor asks about ASO. Hey, Gary, how are you doing? So, Academy Sports is at $52.60 per share. They're down by $1.21 currently, and they were down by 46 cents the day before. So, in terms of the dividends on this, because we've looked at this the past couple weeks, they're only been paying dividends for 3 years. Their dividends are at 0.99%. Why? Because they're claiming that every year for the 3 years that people have owned this stock, they've gotten 20% extra in money. So they're claiming that their dividend yield is 2.99%. However, we look at the history to validate that or not. So we go back. We go back 3 years. 3 years ago, we'll say 2024, 2020, they're still showing 2024. 2023, November of 2023, $47.28. Well, it has gone up. It's at $52.60. But what they are trying to account for in that to the March 2024 time when it went back up to $75. But a bunch of people sold out when it reached $75, and it never came back to that price again. So how are they forecasting on this that it's going to reach Well, they're pretty much repeating history in the forecast. They're saying that wait for it to get up to $70 again, and a bunch of people are going to cash out and ride this down to 47. They think that history will repeat itself on this stock, is pretty much what they're saying. So Mozart says that they've been buying out a lot of competitor insurance companies across the nation. Thank you for the information, Mozart. We appreciate it. Jose asked about FCX. So let's take a look at that. So FCX is $41.46 per share. On that $41, they're offering 60 cents a year, which is a 1.44% dividend yield. They pay their dividend every 3 months. They last paid a dividend July 15th, so they may be getting ready to pay the next one October. Mid-October is what we're looking at. And that dividend is 15 cents every 3 months is what we're looking at. So the price history on this, if we take a little close look, very choppy all the way through. Lots of highs, lots of lows. So we'll get right to the end where it was at the highest. $49.70 June of last year, has not come back from that yet. It had dropped all the way down to $40, and now it's back up to $41.46. So what do our forecasters have to say about this? Well, they're saying that this is a good price because they believe that it's going to go up to $49 in 52 weeks, is what they're saying. If it passes $49, it'll go up to $54. That's pretty much what they're saying about it. Now, the history has shown if it passes $49, it goes back down. So it may just go back to that anywhere between $39 and $40 if we're looking at the price history on FCX, Jose. Let's scroll up. A solid investment that has beat the S&P like crazy is PGR. Okay, let's see. Progressive Corporation. $250.64. It was up $3.55. There are 14 analysts looking at this saying that this is a good price because they think that over 52 weeks, this is going to get up to around $299 $299 a share is what the analysts are saying on this. So have they paid dividends? They've only been paying dividends for 1 year. So this is a common stock prior to that point. So they're saying that they're only paying out 1.98% in the dividend yield. Why? Because their dividend has grown 320% since they announced that they were paying dividends. So that's why they're saying that it's beating the S&P like crazy, because that price per share growth has really gone up over a year since they decided to become a dividend company. Now they have an annual dividend of $4.90 on this 250.64. They break this down and they pay it every 3 months. So they're every 3 months they're paying about 10 cents on this. So they're saying that what they pay is going to now amount to $4.90. So that's pretty much what the story is on PGR and their fast growth per share. Mozart, I hold an MBA, which is in my profile. And those questions like that I've already answered them in my profile. Thank you, on my way. Okay, let's take a look at this. Mozart, I'm going to answer RBLX in just a moment. There was another comment for OXLC that we're going to take, and then we'll answer yours. Oxford Lane. Now, the interesting thing about Oxford Lane is that a lot of articles have been written about them in consumer magazines for stocks priced under $10 that have performed well. So in the past 3 years, Oxford Lane has only been paying dividends. Right now, they're saying that their dividend's at 28%. And let's look at the history to see what's happening with this. Well, when Oxford Lane first became a company, they were at $19 per share. Okay, they have never come back from that. So their peak dropping points are when they reached $15 per share. Then they dropped all the way down to $9.14 per share. Then they've continued. Then they tried to struggle up, and they've dropped down to $4.65 per share, $7.28 per share, and then from $7.28 they never come back. They're at $3.43. So OXLC, even though they're paying the higher dividend, it's on a depreciating asset. So the next time we look at this, even if it goes up 10 cents, it's gone down 10 cents. It's always revolved between three. It's never come back up to that $7. That's why they're paying that 28% dividend yield. So chances are if you buy it, when you sell it, it's going to be less than $3.43 is what they're saying on this. Thank you, Jose, for the thank you. And then I said I'd answer something for Mozart, RBLX. And then I'm going to go on to the next question. Roblox Corporation. So Roblox lost $1.67 at the end of the trading day today. So it's now down to $118.28. So this is not a dividend stock. It's a common stock. So the whole purpose of someone investing in this company is purely if they believe that the price of the stock is going to go up. So we look at the history first for that. And we see where it was left off at in 2021, $113 per share. Then it lost all that money. And it started to come back up in February 2025 when it was $65 a share. When it reached that, a bunch of people sold out, and it was at $58.29. Now it's come back up to where it was $125, and it went back down to $118 from there because it lost some money along the way, including the $1.67 today. So we look at the forecast opinion on it, if we can, if it'll let us. They're saying that they expect Roblox to go up to $120 in the next 52 weeks. So it's another $2 gain. There are 22 analysts looking at it. 10 think that after it passes, if it passes $120, it'll go up to $170. Again, it's purely their opinion and speculation on this stock. And it's a common stock, not a dividend stock. So as much as $2 gain or as much as $50 gain for this year's predicted on it. So that's what they're showing. But also be mindful of when a bunch of people sold out and the price drops. So the price might just drop and you have to write it up again too. So you have to take a look at those trends as well. Mozart. Okay. What do you think of HRB? Would it be a good entry point? Well, let's see. HRB. H&R Block. Well, we're far from a lot of things they do. Most people, it goes up usually 3 months prior to a bunch of people getting their taxes done. And then a bunch of people cash out and it rides down. That's where it's been. So the analysts are saying that at this time right now, don't buy it, because it has decreased from its price target. It's supposed to be around $55 per share, and it's at $51 per share. So they're warning a red alert not to buy H&R Block right now. So we take a look at the history to see what they're saying. And pretty much at its highest, it was at $55.97. And because in the past, it has gone down when it was at 58, 54, 57, and now it's gone down all the way to 51. They're saying that because they predict that price is coming back down, which it may come down to $31. And then as of June of this upcoming year, it may start to go up again, because last year it didn't even go up during tax season, according to their price history. So it went up after the tax season, is what they're indicating on this one. Okay. Thanks for your insight. Thank you, Pro Gifter. And I'm going to answer your thoughts on VU in a second. We have a couple of questions about VU as well. So we will get to that. I just want to make sure that, okay, let's get to VU. Thank you, Pro Gifter, for the thank you. Thank you, K-Dog, for the thank you. Reverse split, good or bad outcome? D-Dog, on the stock having a reverse split. For that, actually, because you have to look at it as a person and actually read into the news and the financials of the company to see what's going on and why. If it's a reverse split because they're taking on a new contract or something and they're expanding or growth, then it's a good thing. And if it's due to something negative to save money or to save something, then it's usually not a good thing. Thank you, Pro Gifter, for your compliments. I appreciate it. And we're going to look at VU, then we'll look at RBRK. Let's look at VU, which is the Vanguard S&P 500 ETF. A lot of dividend investors like it. And this is an ETF that is held in other ETFs, by the way, because it's $588.13 per share. Not many people can afford $588.13 per share. The average person can't. It's usually someone that's getting the $3,000 or more credit from the IRS, that's looking to put money into an IRA right away to sock money away for a retirement. That's where they're buying, 2 to 3 shares of VU in this to just earn money on those dividends. That's like the go-to when you're getting that money back, putting it in the IRA. So VU is paying 1.18% on the dividend. Why? Because they say that every year you hold VU, you earn 4.7% because the price is going up. So you take 4.7 and you add it to that 1.18 dividend, and you're getting 5.88% dividend yield. So that's right in the zone where a lot of conservative investors like to be, between 5 and 8%. That's why that they're into this. So VU, if we look at it from the beginning, when it started in 2010, it was $113 per share when people started buying it and dripping and reinvesting into it. And I credit its growth to the amount of holding, buying, and reinvesting in the fund is where I see the growth fund. There are little points in time where people cash out due to retiring, which they've done, but it's always come back up. And the price has always grown. So here of late, we see January, it was $551. Then a bunch of people cashed out in January. Then it rode back up from May to currently. It went up from $551 to $588.13. So, quote unquote, from a lot of my dividend investor buddies, you can't kill VU. You could try, but you can't, because the amount of people that invest and reinvest in this fund is ridiculous. That's why it goes up. So even when it loses a little bit of money, it always has come back. And we have those stats from 2011 to prove it with VU. So it's a very excellent ETF to be in, but a lot of people can't afford it. So they look for ETFs that have VU in their holdings, is what they do. Thank you for the thank yous. RBRK. RBRK. Is Rubric Incorporated? Thank you for the hearts. So they're at $83.97 per share currently. And this is not a dividend stock. It is purely investing in it on the price that it is and gaining money on the price versus versus waiting for that dividend to be paid. There's no dividends on this whatsoever. So if you're looking to buy in at $83.97, which it lost $1.75 today in the market, you want to make sure that you're earning money on it. Now, looking at these stats, getting my head out the way, we're just going to look at this last little bit over here. It was 87.65, and from there it kept dropping to 83.97. It was 87.65. Gosh, I'm not seeing that price anymore. What am I seeing here? I'm seeing it was 94.95 on July 31st, and it's gone down, 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 so to where it is currently. So it just started losing money again in July. It hasn't been able to stay up where it was in June of this year. So it hasn't been able to hold that price. So what are the forecasters saying about this stock? They're saying that they believe that this stock is going to be $98 per share over 52 weeks. That it may drop to 40 and come back up, is what they're saying. So they're saying that because 83 is farther away from 90 currently, but it's still close enough, they're still saying it's a good buy to get in on it. So the history of the stock has just shown it going up and down, up and down, up and down. So what I think may happen is I agree with the analysts believing that it's going to drop to 40. And I would buy it at the lower price and ride it up. But that's just me looking at the price history. You can make your own distinctions and decide. Or you could be, there's 17 analysts looking at this. You could be like the 8 analysts that believe it's going to go from this price to 124. And they believe that's going to happen, but I'm making my assumption based on the price history. But again, I'm more of a dividend investor, and this is a common stock. I'm just giving you my 2-cent opinion. What about Intel stock? Well, let's see. Again, Intel is a stock that is held in tech-heavy ETFs, grouped together with other stocks to buffer the wins and the losses. So currently it's at $25.31. It's up $1.65. It has surpassed the analysts' expectations where it thought it was just going to stay around $22. So now there are 10 analysts that are saying that this could go from $25 to $29. But regardless of how much higher it gets this year, they're saying right now, don't buy it, because they're afraid of a bunch of people cashing out and it dropping down to $14 before it goes back up again. That's what the consensus of the analysts are saying, not to buy it, hold it if you own it, don't buy it at all, is what they're saying. Pro Gifter, I just gave my thoughts on VU. I hope you saw that. Jordan, I just gave my thoughts on NVIDIA. I hope you saw that as well. Okay. Merck, look at my video that's pinned with the blue screen for your answer. And then Richland asked thoughts on Stag. Thanks. I'll pin your comment. $36.09 is Stag. They're up $1.74. So they are close to where the analysts predicted they would be, because the analysts think that it's not going to get any higher than $37 in the next 52 weeks. And they're saying that we're right at the line where it was a buy maybe last week. It's not a buy now. The needle is pointing to yellow, where the 7 analysts are saying, whoa, hold it, because it's getting close to the price point we predicted. So we don't know from here if it's going to go up to 40 or a bunch of people are going to cash out and it's going to go back down to around $34. So that's what they're saying on it. In terms of dividends, they've been paying dividends for 14 years at 4.34%. Their dividend growth has only been 0.68%. So for every year someone has held the stock, we take 4.34 and we add 0.68% to it to get what the total price would be. That 0.68% is going to come when you sell it, and 4.3% for as many years as you hold it per year. They pay a dividend every month, and their annual is $149 per share. They divide that into 12, and they pay you 12 cents every month on it. And that's how STAG works. Okay, and let's see. Kevin, we did Palantir already. I'm hoping that you saw it. And let's see. What do you think of GEV? Thank you for the hearts. Is GE Vernova Incorporated? They have an annual their stock price is pretty high at 603.13. And I mean pretty high from the standpoint that it's higher than even buying a share of VU. They lost $21.89 at the end of the trading day today. Yesterday they lost $6. So they have only been paying dividends for 1 year, and the dividend that they're paying is 0.17%. But they were hoping this would be a stock that grew, but actually with all the losses on the stock, they're not showing any more dividend growth on the stock either. So pretty much, let's see what our forecasters have to say about it. So 22 analysts that look at it say, well, hey, despite the losses, we believe this company is going to bounce back, because they did surpass the $559 that we predicted it would be at, and now it's up to $603.13. So we're still thinking it's a good price to keep on buying it, because we believe the price is going to go up to $734 per share, because the price has surpassed what our median is. That's what 22 analysts have to say about this stock. Again, that's just their opinion. Now, if we look at the history on this, we can see how the company has just continued to go up with little minor changes. And what we're looking at is that the stock was $657 earlier in August, on August the 12th. And it's gone up to $603.13.
No.
Okay, I will. Thank you very much for coming by. I got toddlers wanting to hand me things to come and play, which it's almost their bedtime. So I'll be letting us go in a minute too. But pretty much with the GE Verona stock, it looks like they're still continuing to peg it as going up. But thank you, Jorge, for the rose. They are going on the losses right now. For the analysts are saying, don't pay attention to the losses. It's lost $21 today, but we still are optimistic about it going up. Okay, we have a bunch of questions about NVIDIA, but I went through them earlier. So Kayleigh says, I'm up 25% on Intel. Well, good for you, Kayleigh. We're glad on that. So I'm going to look at NVIDIA, AMD. Let's see. Let's look at it. Let's do a quick recap on NVIDIA, because I believe that we got so many questions about it. People may have missed what I said about it earlier. But NVIDIA is 175.64. Typically, there are experienced dividend investors that prefer to focus in on NVIDIA in an ETF holding with others, because when it has losses like this one today of $6.37, the other companies shore them up so they don't have a loss. Okay, thank you. Thank you, I'm busy. Okay, I will, I promise. I will. So in terms of dividends on the company, I'm going to ask you guys to just give me 1 minute to answer your question. You could see the dividend yield here. I'm going to attend to a toddler and be right back. Okay, thank you. Okay, thank you very much. Okay, I put this in the garbage. I put that back, and just excuse me for a few minutes. I'll come to bedtime with everybody in a few minutes. Okay, so pretty much here, what we have with NVIDIA, they've only announced, because before they were a common stock, is what I had explained before, they've only been paying for dividends for 1 year, but in 1 year, that price shot up 81%. But right now the price is going down, and that's where the investors are concerned, because this was a common stock before. They're not used to this being a dividend stock. So because they're trying to say that it shot up 81% in 1 year, they're paying that 0.02% dividend. But really, when we look at the price history on NVIDIA, they're trying to take account for growth from March of this year to currently, saying, hey, because of this 80% increase, that's how much it is. But these figures are greatly miscalculated, is what I think. But investors and analysts love NVIDIA as a single common stock and in an ETF. They're still encouraging people to keep buying it, because they're saying that this price is going to go up to 189 in 52 weeks. And then after it crosses 189, they believe it's going to go up to 250 based upon the current growth. It's just going to keep going to 250 based upon the recent events of March to current. That's what they're basing this information on. So when you look at the price analysis, you'll see that they're only basing it based upon less than 1 year of information, even though NVIDIA has been a common stock for a very long time. And then we were asked to look at AMD. Thank you for the hearts. I appreciate it. So AMD is also another company that's held in many ETFs. AMD stands for Advanced Micro Devices. They're 166.55. They are also down $9.59. But we've got 34 analysts looking at this that said, so what? Like they did to NVIDIA. So what if it's down? Because this thing is going to go up to 171 in 52 weeks. So what? It's an okay price to buy it at 165. It's going back up. And when it hits 171, it's going to go up to 210, is what they're saying. So they're advising people to hold on. Now, there are, out of the 34 analysts, there are 4 that are not so optimistic. They believe that the price is going to keep dropping to 110. Then it's going to go up to 171. So we have a little bit of a difference of opinion, but it's still the same. Both believe it's going up. One smaller set of analysts believe that it's going to go down then up. And the other one, the higher balance of the analysts say that, hey, this is going to keep on going up to 210 per year, is what they're saying on it. So let's see what else here. We just answered NVIDIA. We answered AMD. And let's see if there's anything else. Thank you, Jorge, and thank you for the roses. We appreciate that. I got the Enbridge dividend, and it's one of the best. We're glad you got your Enbridge dividend, David. Thank you for sharing that with us. We love hearing people get paid their dividends. That's just the best. ANET. Arista Networks is $132.78 per share. They lost $5.26 today at the end of the trading day. But the analysts say, there are 13 analysts looking at this, and they say, you know what? We don't care. This is going to go up, and this is a good price still. 132, huh? It's just the lower price. We're still recommending it as a strong buy. because we believe that this is going to hit $140. Once it surpasses 140, it's going to go up to 155. That's what we're saying. So that's what the analysts say on it. Now, this is just purely a common stock. Arista does not pay any dividends. So they're saying that there's an opportunity to make anywhere from 10 to 50 bucks extra on this per year for this year is what they're saying about this being a common stock, basically. If we take a look at the history really quick on it, we could see where it was low and now it's high. We go back to the two interesting price points. In January of this year, it was $129. A bunch of people cashed out and rode this down to $91 per share, and they rode it back up to $132, where it is, just to take a look at the recent example. So, and we have Run Faster 100. Hello, very informative. What are your thoughts on ASML and Costco? Okay, well, let's pin your comment and let's see. ASML. I think we looked at this one. It was $743.61 per share. ASML Holding Nevada is $743.61 per share. So if we look at let me get my head out the way here. So if we look at the recent history on this, at the highest it was $876, and it rode all the way down. If we take a look at where it is, it rode all the way down. As a matter of fact, it went down to $662, and it climbed back up to $743.61 where it is. In terms of dividends, so they've only been paying dividends for 1 year. And they're saying that based upon the 1 year, that you add 8% to that 0.82% dividend is what they're saying. My personal opinion is that 1 year is not enough history. I like a 10-year history. But then there have been companies like Main, ticker symbol MAIN, that have thrived on a 4-year history and not missed a dividend payment. Usually the closer they are to under 10 years is when they are more apt to decide that they're going to stop paying dividends. But this company has had such growth. But the concern is they've had a higher payout ratio since, I'm just reading the analyst report, that because of the higher payout ratio, they're concerned about the stock continuing to drop in price. So there are some forecasters believe that, yeah, this is going to keep going up. But when it gets up to past $8.14 per share, it's going to drop back down to $7.47. So a little bit above where it is right now is what they're saying. And then we're going to look at Costco for you. So Costco is up to $980 per share, but the analysts are like, okay, it's going. They think it's going to get to $1,200 in 52 weeks is what they're saying on the Costco. So I had a couple of Costco employees talk to me about the stock because they're in management at Costco, and they have some stock buying equities and benefits with their packages as well. So they're going to hold their Costco stock but their information is biased. They work there and they like the direction the company is going in, but the analysts also seem to be very positive about it too. Now, overall, over 10 years, it has shown not so much of a dividend growth, because usually when the prices get up this high, people do cash out. But Costco has never missed a dividend payment. And looking at the top financials here, the forecasters are believing where it was 102.186 in February, that in the next 52 weeks, it's going to come back up to that price again and surpass it, is what they're believing. And they're believing that the dividends are still going to be paid. So it's only a 0.53% dividend, but currently, until it comes up to a little over $1,000 a share, it's a negative price growth that it's in right now, even though the price is coming up on it. So I hope that answers your question. Thank you, Mateo, for the thank you. I appreciate it. Thank you. And then Paul, we're going to look at DUOL for you. Duolingo. Okay. Now, Duolingo is at 340.66. They're down 28.53. This is not a dividend stock, it's a common stock. Why is it down? Well, they're saying that there's some AI coming in to compete with Duolingo, that they have their own type of platform, but what's about to be released in the next 6 months is going to put them behind. So that news is catching up, and they haven't announced any new innovations as to how they're going to compete or do better with this. That's why this company's losing, it lost $28 today. They thought that they were going to have an answer yesterday, lost 66 cents. So investors are waiting for an answer from them, and I don't know what they're going to come up with. But there are 15 analysts looking at this that are optimistic that Duolingo has a unique enough platform. They've pre-examined some of the AI that's coming out to compete with Duolingo, and they're saying for younger children, it's still easier for them to learn from this platform, and they don't believe that many people are going to leave it, and they believe the price is going to go up to $4.20 per share over the next 52 weeks. That's what they're saying. There are 3 of the 15 analysts that say, yeah, it's going to go up, but we believe it's only going to go up to $3.70 over 15 weeks, Paul. So that's what they're saying. Okay. Now we have 12 questions here on the back end, but it's also past the 2.5 hours that we're usually on. So what we're going to do is pick back up with our meeting again on Thursday at 9 p.m. Central Time. If you come back, I'll put out some videos on information in between then. For the 12 questions remaining that weren't answered, my interns will give that to me, and I'll put that on the Patreon for free tomorrow, along with is there any more than 12? No, there shouldn't be any more than 12 questions. But I thank you, Atlas. I thank you, Pump. I'm so happy for all of you that have gotten returns on your income. Basically, we were focusing in on ETFs primarily tonight because it's a nice way for a new investor or an existing investor to invest in like 30 to 50 companies at once in some of these portfolios. And to really, if you like tech and you want to invest in a whole lot of tech, you can. We saw one with water. There are energy resource type ETFs that are energy based on electricity, based on water, based on oil. In summary, there are over 4,000 ETFs. It would take us all year to get through them. But we'll get through as many as we can because in here we look at everything like a person. So I thank you for your attention. And please follow me for free updates. Follow the Patreon for free information. And I look forward to seeing you guys this Thursday at 9 p.m. Hug the ones that you love and care about. Hug yourself. And I want you to win. So I'll see you again on Thursday night.